Hello, my YouTube friends, and happy Monday. Well, not exactly a happy Monday. I like it better when the markets are open, but I know some people like those long weekends. I enjoy the markets. I like to watch them. Anyway, today I'm going to talk about three stocks that I've already placed the order in for that is going to help me in that dividend retirement switch, the rotation that I've been doing. So I'm going to talk about those three stocks as well as some other things. I'm even going to talk about those yield max funds and some of those covered calls that I am not adding to the account, why I'm not adding them, and what my concerns are with them. So stick around. Today should be a great video. Before I even get into why I'm picking the stocks and whatever else, so you don't have to wait until the end, the three stocks that I'm buying that I've already put the orders in for are HESM, Hess Midstream, PRU, Prudential, and MLPA, which is an ETF of different MLPs, which similar to Hess Midstream are, the ones that kind of transport and deal with the oil and help the companies. And I'll talk about why I like each of those stocks as we move along. And I do want to get into why the market is rotating in general, as well as why I am, because I think the reason that the market is rotating is different than my journey. This is my dividend retirement. Like I said, I always leave those bloopers in. But my goal is to generate a certain amount of income so I don't really have to pay too much attention. I'm buying these stocks a little bit more aggressively because I don't want to miss opportunity because I think they're really well priced for the dividend that I'd be getting. And one stock, Verizon, that I'm not adding on to quite yet or buying because it's already run a decent amount. I only have about 15 to 20% of what I'd like to have on, but I don't want to chase it either because here's what I've noticed about the rotation. As people have been selling off tech and buying into safety or what they perceive as safety, they're almost doing it indiscriminately where they're not paying attention to valuations. They're selling anything at any price and they're buying anything at any price. Now, I'm going to talk about my favorite, which is Target, for a bit and explain it to you real quickly. And it's not because I'm pushing Target again. Oh, yeah, it is on. Sorry, I got a little bit nervous because I didn't see the little green light, which usually shows in the camera. Anyway, so why did I buy Target instead of Costco or Walmart, which are two companies I actually like better than Target? And that comes down to valuation. Now, Costco, I can make an argument for. It's just very hard for me to spend close to 50 times earnings for a company growing at 10%, but that just means it'll take longer for it to catch up to where I'd be comfortable. But Walmart, it's very hard. Like, I'm not ready to pay. They're trading, if I remember correctly, 45 times forward earnings. Maybe it's 43, but they're growing at about 5% year over year. So I'm just so uncomfortable paying that type of multiple for a company growing at the pace that it's growing. And when I flip the script and look at Target, which I do not think is as good a company as the others, but it was trading at an 11 times multiple, and the stock was growing just as fast as Walmart, and they were paying a 5% dividend using only 50 some odd percent of their free cash flow, making it super safe, even if there's a slowdown, to be able not just to pay that dividend, but potentially even raise it. The only thing I liked about Walmart is that they're only using 30 some odd percent of their free cash flow to pay the dividend. But if I remember correctly, it's like a 1.5% yield. So even though they're not using a ton of their free cash flow, it's a very small yield and a super high multiple. So as I'm making the rotation, it's not just totally ignorant of the valuations or anything else. I might overpay for something because I'm anxious and I don't want to miss an opportunity. Hess Midstream probably fits into that category. But overall, I want people to be really cautious about what they're selling, the valuations of the things they're selling. Are they totally overdone? And are the things that they're buying making sense as well? I just don't want to see people just buy whatever they think is safe at any price, sell whatever they think is dangerous at any price, because the market definitely seems a little bit emotional right now and a little bit overdone. That doesn't mean it may not be the right time to make changes, because when I look at what's going on with AI, to be fair to the market rotation, there are things that people should be concerned about, and nobody is going to know how software is going to play out going forward. The things that AI is going to replace, the jobs they might replace, the destruction it may or may not cause. Like, it's hard to tell. When I flip and I look at like consumer staples or food stocks or things of that nature, while AI might help enhance their system and make them more efficient at moving products or whatever it is, it's hard for me to envision a scenario how AI disrupts something like, forgive me for using Kraft Heinz because I think they've taken on a lot of debt and they may have some other issues, but it is one of my purchases. But a company like Kraft Heinz or Conagra that I've talked about a whole lot, my guess is that they continue to sell food, and you are not going to see the AI market just come in and totally destroy those companies. So I'm super anxious to put a little bit more into Prudential, which is a stock that I already own. I think it's pretty secure in the space that they are. Their insurance, for those who don't know, I think people do know. If I remember, were they, put in the comments section, were they the good hands people if you lived on the East Coast when we were kids? I kind of remember, like, I don't know if that was them or not. Anyway, their revenue is really consistent. Their business seems pretty strong. They're paying a really good dividend at over a 5% yield. And I know you saw in my other video, I talked that I'm hoping to get between a 4 and 6% over the entire portfolio. And I'll have some that pay more and potentially some that pay less. But that's my goal for overall, to get to the goal of what I'd like in terms of annual income. And it doesn't matter to me whether I have it come quarterly or monthly or however it comes. But Prudential's paying a really good yield, and they're only using 50 some odd percent of their free cash flow in order to pay that dividend, which is one of the things that is super important to me. I don't really want to get into too many companies like Hess Midstream and MLPA. They're going to use a higher percentage just because of the way that type of business works. But I don't want too many things that are high-flying dividends without a whole lot of chance of getting it, which gives me a good opportunity to talk about yield max. And before I do, because I think that stuff is super interesting, as well as the other super high, because I don't want any, or very few, if I have any, covered call strategies, and we'll get into that. But before I do, as always, this is not financial advice. Please, you should not be listening to me. I am not a professional financial advisor. You guys really need to do your own research when making your decisions with your finances. I am just a guy on YouTube doing this for entertainment, sharing my journey and the things that I found that have worked for me. You guys need to figure out what works for you. So, what is my problem with yield max in particular? And then I'll also talk about generally covered call spreads or covered call strategies, which, don't get me wrong, I sell calls on my stock, so it's not like I'm opposed to options or selling calls or even necessarily selling puts to get into a trade. But let me tell you about a little bit about yield max, which I've talked about in my other channel, but I wanted to address here. So what they do is they get synthetically long a stock. And what exactly does that mean? That means they don't actually buy a stock. So I'll use a made-up stock because I don't know, like, I know Tesla's 400 and something, but I really don't watch a lot of things close enough to know exactly where they're trading or use their actual options price. So instead of buying stock X, which let's pretend it's trading at $100 a share. Well, to trade an option, you need to have 100 shares of that stock. You'd have to put up $10,000. Pretty easy to understand so far. If you're buying that stock synthetically, instead of buying 100 shares of that stock, you buy one call and you sell one put. If that's confusing, I'll explain real quick. If you buy one call, that gives you the option, hence the term option, to buy that stock if it goes higher, above 100, because it was trading at 100. Everybody with me on calls? Generally, they're pretty easy to understand, so I hope I don't have to go into it too much. And maybe they pay $3 for that call. Again, just making it up. Then they sell the 100 put. So they bought the $100 call, gives them the right to buy the stock if it goes higher. They sell the $100 put, and maybe they collect the same $3. So now they haven't really put any money out of pocket. They spent the same amount that they received when they sold the put. By selling the put, if stock X goes lower, the person who bought the put is going to exercise that, meaning the seller, the fund, is going to be forced to buy 100 shares at $100 as well. So whether the stock goes up or down, they are long the stock the same way as if somebody bought 100 shares. So why would they do that? Well, there's a whole bunch of reasons. One, you work out a deal with the company that you're clearing through. Instead of putting up the 10 grand, you have a certain amount of margin requirement to have that position. I think pretty standard might be 25%. So buy the call, sell the put, no money out of pocket. All I have to have available for the risk of that trade might be $2,500 instead of $10,000. I can do 4 of those instead of the 100. On top of it, by not actually having to put up the $10,000, maybe I can buy a treasury or put it in a high yield savings or something else instead where I actually generate a return. It's not such a terrible idea depending on one's goals. If a stock pays a dividend, there's a little bit of an issue with that. But on something that doesn't, where it doesn't impact it, that's kind of a reason why they get synthetically long. It allows them to leverage, is the main reason. It also can leave the cash in an interest-bearing account to gain some interest. Well, so now they've got a leveraged position on. They then sell an out of the money call to collect their distribution, which is not a dividend. I get it. It's a little bit different. So let's say stock X that was $100 that they paid $3 and received $3 for the put and the call that they bought and they sold. And now they sell an $110 call for $1 to receive a distribution and be able to pay that out to people. Here's the negative. You've capped your upside. If the stock goes crazy and goes up to $130, you are forced to sell it at the 110 because of that call. And if the stock plummets and goes down, you have the full exposure you would have if you were just long the stock. So you do not limit your downside. You limit the upside in order to pay out that distribution. And what people are finding out is these funds are having a big drop in the NAV, which is the actual value of the company, in order to be able to pay out the dividends. What I really don't like, the reason I harp on the yield max funds, is the sales pitch. The guy who runs the fund talks about how great they are because as somebody gets older, if they're in a position where they haven't saved enough money to retire, this is a way to drive a higher percentage return so that they can live off of it. Then he follows up because people give him a hard time about the value of the fund dropping and says, yes, but to get the type of return that one should, they really have to reinvest those dividends. Otherwise, it's going to deplete over time. So you're selling it to retirees who might need the higher yield in order to pay their bills, recognizing that if they don't put that yield back into the fund, that money is just going to become less and less valuable until it's gone, and you're not going to get any yield. So how dare they actually sell it to retirees as this great thing that's going to help them if they haven't saved enough, while it depletes the money that they do have. Now, forgive me, I don't mean to go on a rant on it. My general dislike and why I don't want to use covered calls in my account was the last part, which is that you cap your upside and you don't cap the downside. So if we go through a real recession or a real correction in the market, even if the ones that are safer, and look, I totally respect JEPI and JEPQ, and they might be something that I implement into my returns. So I really don't want to hurt wrong way. Maybe there's some good ones out there if they're taking a little bit less risk. But I don't want to have these funds on because if we end up having a real correction, you're going to find out that they're going to have the same type of down move that you didn't expect and you just thought you'd get your returns from the covered calls being sold. Now, hopefully that doesn't happen. I'm not super bearish the market, but I don't want to have an ETF on that has full downside exposure, limits my upside, because if we do have that correction, I don't want to get caught in it while I've limited my potential to have profits. And now right back to the stocks I'm buying tomorrow. Sorry, I think I'm funny. At least I crack myself up. Nobody else thinks I'm funny, but I'm okay with that. So Hess Midstream and MLPA, why am I buying those a little bit probably ahead of schedule in some ways? First of all, I have some cash on the sideline that I've been waiting for anyway. I am selling some covered calls on the growth stocks in order to slowly sell. My guess is my timeline is over the next 3 to 5 years to really rotate and transition into just dividends and not have as much growth. And I don't plan to never have any of the growth. For example, like I think Meta is really well priced here. It could go significantly lower, especially if we end up having a slowdown and sales get worse. But otherwise, their projected earnings are friggin' incredible for a company their size. Their PE ratios are way too low. I think it's discounted because of that lawsuit in Mexico that I was reading about. Maybe that I think people hate Zuckerberg, so I think that it tends to always be a little undervalued. Either way, I find that Meta is a really good value, so I'm not looking to panic out of it. Maybe it's a mistake. I don't know. I'm not super concerned either way. Now, that being said, Hess Midstream is expecting to pay a yield of like 8.8%, I think, if I remember correctly, on their forward profits. And they weren't included in it, but it does secure their contracts. Like they're primarily the company that handles the midstream stuff for Hess. Well, Hess has just been bought out by Chevron. Not just, but it's been going on a little bit. So I think that really secures their contracts. I don't see it being something that's going to jeopardize their business. I think it's causing people to be a little bit nervous, like what's going to happen going forward. But Chevron is such a bigger company that I think, if anything, it's more likely to secure that even better and potentially cause it to where there's more, like they'll want them to expand and do more business. And maybe I'm wrong. My only concern with it is Chevron is like my third largest position. So I don't want to be too invested in just the one company. It might mean that I should consider either selling calls, which get very little amount on Chevron because you're already getting a nice dividend, but maybe rotate some of it out into Exxon or potentially a higher yielding dividend stock because Exxon pays a lower dividend. But that was why I bought Hess Midstream. I like that yield. I think it's pretty safe. It doesn't have anything to do with oil prices other than as they go up, the companies are profiting more. It's more related with interest rates and other things. And MLPA, same reason. I kind of pushed into it sooner than later, simply because it's paying over a 7% yield. Between the two of them, it gives a little bit of a boost into that range that I wanted to be in. So if I find something only paying a 3% dividend that's a company I really like, that I think is still growing, it helps to balance that stuff out. What do you guys think? Are these companies in your portfolios? Are you in the midstream stuff? Is Hess one of the ones you like? Do you hate it? What do you think about Verizon that I'm holding off on? I think I mentioned it. Like Verizon, I want to buy. It just had such a run up after the earnings, and I have that small percentage that if it gets back down below $45 a share, I mean, I'd love to be able to pick it up around 42. But the reality is, even at a 12 times multiple, which is really low, my concern with Verizon is they're only growing at like a 1, maybe a 2% increase year over year, and I just don't see a ton of growth in it. So I don't know how much they'd be able to raise that dividend going forward. Now, I think it's secure. So if we run into an environment where they're cutting rates and you're seeing interest rates coming down, I think that something like Verizon could go higher. Fortunately, I have a small position in it. It's not like I have nothing, but I'm not about to chase it up here because if it's paying less than a 6% dividend where I don't see a ton of growth in it, I just am not ready to pay up to follow it along. Maybe it's a mistake. Maybe I should just jump in. And now back to my little disclaimer for a second before we call it a day and I go hang out with the family. Part of why I say what I say is I actually believe it. I'm not just saying it because it's a requirement or anything else. First of all, nobody can predict pricing. I don't care what they tell you. I don't care what charting. I don't care anything. Nobody has a crystal. Well, I used to have a crystal ball, but my son and his friend were playing volleyball and broke it. So maybe I have to get a new one. They sell them on Amazon. It didn't help a whole lot, but I did have a crystal ball And at one point, I'd be like looking into it, trying to predict the future because I thought that was funny too. Anyway, nobody has a crystal ball and an ability to tell you where a stock is going to be, where it's going to trade, higher, lower, whatever. No different than telling the future for anything. Like, they can use their analytics or whatever they go to make them think that they have some ability to foresee something, but there's just too many variables that can change things. And on top of that, like, go watch Dan Niles and see how specific their algorithms are to recognizing the difference of a leap year versus a non-leap year, when Easter actually lays in which quarter because that impacts it, and. Like, they go beyond when they're doing their analysis. So if you think you sitting at home, reading your papers, doing your charting, whatever else, like, that's why I just buy and hold. I have the saying of like, buy low, sell never. And I've really stood with that for a very long time, and it's worked out great. If you stay with companies for, I would say 10 years or longer, but sure, 5 years, 10 years or longer really allows that compounding to happen, and what I would call short term moves to kind of dissipate into the wind. Something can, like, short term can be a year or two. And if you watch the consumer staples and some of those out of favor stocks, my God, their earnings are fine. They seem to be doing okay. A lot of them pay a decent dividend, and they have been out of favor for 4 or 5 years now. So I don't know. Eventually it changes. I've watched stocks that would go on a 10-year, very low, slow, boring trend to finally reverse whichever direction that is and start going the other way. So if you are an investor and not a trader, well, if you're investing in a company, it is for the long run. Pick companies you believe in, that you care about, that you think will do great over the next 10 or 20 years, not over the next 10 minutes. You know, Warren Buffett says if you're not willing to hold a company for 10 years, you shouldn't own it for 10 minutes. I think that's good advice. As much as I play around in my trading account, keep in mind, and when I talk about it, first of all, it's a very small percentage of the portfolio. It's more fun, it keeps me active, I like to pay attention, but it is not a major percentage. On top of it, who knows? It's just guessing, and part of it is I put on such small trades that I'm not super worried about it. So if they're wrong, I can generally hold it against me and wait it out. And if not, it's a little enough money that it's not the end of the world. Most of the money is kind of what I call set it and forget it, because I really set it and forget it. And some of these things go against me pretty good. Like, I bought PayPal as one of my newer holdings that I bought before their last earnings, before they collapsed, but I still think the stock is okay, and I didn't put a ton of money into it, so it is what it is. I've talked about Starbucks a few times that I've been long from $112 a share as it dropped. I have to look and see what the low is, but it may have gotten below $70. But I still think Starbucks is a good company that's going to be in business and fits into these defensive things that I don't really see AI destroying the coffee sales business. You know, they have competition, but what I find happens is when new technology and market corrections and everything else come along, and the market correction timeline is when the old big top companies tend to perform, which is what I think is going on with McDonald's. Like, I see them beginning to take market share. They're growing, they're doing great, as Wendy's is getting rid of stores and canceling places. Now, whatever people's opinions are, but I think when the things get tough, those really big companies have an ability to just trudge through it and do really well. Again, be really careful if you're rotating. I'm rotating, but for my own reasons. I would still pay attention to valuations because I don't want to see people just chase whatever it is because they're nervous about what they're in, getting out at any price and buying whatever they think is safe, because I don't know. That's kind of why I say it's not investment advice. But I think jumping into Walmart at 40 plus times earnings just because it is a safe, well established company seems super aggressive to me. May work out great, really. They're a great company. I'm not telling anybody not to buy it. Anyway, have a great Monday. Geez, I keep forgetting. I think it's the weekend. Today is Chinese New Year as well. That's what we're going to a friend's house and we're gonna celebrate. Get to give out some red envelopes. Maybe I don't drink, but I'll probably bring drinks for the people there because most of the people do, and hopefully it's super fun. Don't forget tomorrow, 11 o'clock on my other channel. I hope you guys can make it, Billy. I know, I get it. You're on the other side of the world. Maybe I have to do one at a different time because I really enjoy our chatting back and forth in the comments. Super selfish time. Yeah, I'll put up that little thing that I like. Um, but it fits my day, and Tuesday, 11 o'clock Pacific time, I do the live. I love the platform. I hope some of you can make it. Anyway, have a great day. Happy Chinese New Year. Hopefully, it's as beautiful out where you are and you're getting to enjoy the weather. Bye bye now.